Is Chevron, ticker symbol CVX, a good stock to buy now? Welcome to Global Value. In today's video, we're performing a fundamental analysis of Chevron using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Chevron is worth in today's stock market. Plus, I'll share a special bonus that could be the deciding safety factor when adding Chevron stock to your portfolio. Right now, Chevron stock trades for $156.42. In its last day of trading, it's up 0.06% alone. Since July of 2023, Chevron stock is up just 1.4%. This lags the S&P 500, which is up 25% at the same time. In the last 5 years, Chevron's compounded at 4.6% annually. Over the last decade, their stock is up 18.7%. They've lagged the market over this time. And when we go back before the global financial crisis, in the last 19 years, Chevron's compounded at 5.8% annually. Chevron's had periods of both outperformance and underperformance in its stock. Thankfully, these returns aren't the only ones for shareholders. Right now, Chevron pays a big market-beating 4.01% dividend yield. They've grown their dividends in each of the last 37 years, making them a dividend aristocrat and possibly one day a dividend king. When their dividends are added to the gains in their stock, Chevron's actually beat the market in the last 2 decades. It goes to show what slow and steady can do to win the race. Right now, Chevron trades $15 below its 52-week high. They're up $17 from their 52-week low. And how big is Chevron? Today, they're the second largest oil company in the United States with a $288 billion market cap. Today, Chevron's owned by 6 super investors, and this is led by Warren Buffett, who has 5.85% of his portfolio at Berkshire Hathaway invested in the company. In the first quarter of 2024, we know Buffett was selling. He reduced his stake by 2.47%. Chevron's an unusual position for Buffett, who's been buying or selling the company 14 quarters straight. Buffett bought most of his position 3 years ago, and he's been trimming as the company's traded higher than the levels it's at today. Starting with our first metric, we want Chevron's average returns on capital to be greater than 14%. These returns tell us how much value the business is creating. On average, companies earn 7%, so we can build in margin of safety for ourselves here. Chevron, as an integrated oil and natural gas company, is going to see their returns on capitals ebb and flow in cycles. This is a cyclical commodity industry, and these returns are going to reflect that. For example, when the price of oil went negative in 2020, Chevron's returns on capital went negative. However, as things have rebounded and there's been somewhat constrained supply, in 2022, Chevron earned over 20% returns on capital. That's a swing of more than 20% in just 3 years. Overall, we want to average these out so we can get a better feel for things long term. In the last 5 years, Chevron has brought in around 9% returns on capital, although they've only been at this spot in 1 year in 2021. Today, these returns are higher at around 13%, but they're still below our benchmark. It's an X on metric number 1. Now let's learn more about Chevron. Chevron is an integrated energy company with exploration, production, and refining operations worldwide. It's the second largest oil company in the United States with production of 3.1 million barrels of oil equivalent per day. This includes 7.7 million cubic feet a day of natural gas and 1.8 million barrels of liquids a day. Production activities take place worldwide, but its refineries are in the US and Asia for total refining capacity of 1.8 million barrels of oil a day. Proven reserves at the end of 2023 stood at 11.1 billion barrels of oil equivalent. This includes 6 billion barrels of liquids and 30.4 trillion cubic feet of natural gas. When we're talking Chevron or their peer ExxonMobil, we're talking huge scale. Right now, there's a lot of deal making in oil and natural gas. However, Chevron's $53 billion purchase of Hess remains stuck in a holding pattern. ExxonMobil claims that it holds a right of first refusal to Hess's assets in Guyana, which are key to Chevron's interest in the acquisition. But arbitration between the two sides hasn't even started yet. Both Exxon and Hess each selected one arbitrator, but they need to agree on a third, which they haven't. At this rate, arbitration's likely to drag on into 2025, meaning Chevron is stuck for now. In metric number 2, we want growth in their sales and their free cash flows. Even with returns just slightly better than average, it's harder to make mistakes investing into growing companies. This is what we want from Chevron. In the last 5 years, their sales have swung with the price of oil. In 2019, they had $139 billion in sales, and this dropped to $94 billion in 2020. Oil's rebounded since then, and in the last 5 years, their sales have grown by 38%. At the same time, Chevron has more control over their cash flows. These have grown by 39% in the last 5 years. What's really important to note here is they had positive free cash flows in 2020. This was even despite negative oil pricing in the beginning of the year and reduced demand throughout. That's a sign of a durable commodity business. Great to see for Chevron. It's another check on metric number 2. In our third metric for an oil company, we want their shares outstanding to be decreasing. From 2019 until today, Chevron has reduced their shares outstanding by 1.5%. They've been buying back shares from 2022 onwards. This is technically a check on metric number 3, but their $53 billion acquisition of Hess was done using all shares. That means their shares outstanding are actually going to spike over this time once that acquisition goes through. Now in metric number 4, we're starting to put things together. We want free cash flow per share growth. This helps us look at Chevron from the view of an individual shareholder. While their cash flows have swung around, they've been positive in all 5 years. This, coupled with their share buybacks, means they've grown their cash flows per share from 2019 until today. Now it's time for our first bonus as we look at the company's dividend. Right now, Chevron pays a market-beating 4% dividend yield. But is this safe? We'll learn that in our bonus as we want their cash flows to cover their dividends. Chevron's a dividend aristocrat, growing their dividends for 37 years straight. In the last year alone, they increased their dividends by 7.17%. As we can see by looking at this chart, Chevron has covered their dividends in 4 of the last 5 years. 2020 was the only exception. It was not a normal year for the oil and gas industry, but this may not have been the best choice from management to continue paying these dividends. In hindsight, things worked out fine, but it perhaps wasn't as clear back then. Still, Chevron has comfortably supported their dividends in the last 3 years, and they do so today. It's a huge check on our bonus. Now, as we look at their balance sheet, in metric number 5, we want the sum of their cash flows to cover their net debt. Chevron's done a good job of managing their debt over this time. This peaked at $42.6 billion in 2020, and since then they've cut this in half. At the end of 2023, they had $17.8 billion in net debt, and today the company has $15.6 billion. In the last 5 years, Chevron has brought in $93.4 billion of free cash flow. Again, this is on the back of higher oil pricing, and it comes as the company has maintained reasonable levels of capex. Overall, the oil and gas industry has a lot lower capital expenditures this decade than they did in the 2010s. Right now, Chevron's numbers look healthy with modest leverage and strong cash flows. It's a check on metric number 5. Now it's time for our safety bonus before we figure out what Chevron's worth. Ben Graham was the father of value investing and Warren Buffett's teacher. He wanted to see a current ratio greater than 1.5 times. This is a key safety metric of short-term liquidity for how fast a company can pay its bills. In the case of Chevron, today and in the last 5 years, they haven't quite hit this 1.5 times mark. They came pretty close in 2022, but they weren't quite there. For Chevron, they're still above 1 times, and there are reasons why as an oil business this may not be as important, especially as the company has very strong cash flows. Still though, it's an X on our safety bonus, and it's something to keep in mind. The big metric of them all, metric number 6, is also today's first valuation. We want Chevron's average free cash flow divided by their enterprise value to give us a yield that's greater than 5%. This is in line with the historical yield from the S&P 500, and it would give a slight risk premium right now to the 10-year treasury. Today, Chevron has nearly a $305 billion enterprise value. This is the number we get when we add their net debt and their market cap together, and it can help us look at Chevron like it's a private company. In an average year over this time, Chevron brings in $18.7 billion. Remember, that number even includes 2020. When we divide that by their enterprise value, it gives us a 6.1% average free cash flow yield. In their last 3 years, they have an 8.3% yield, and in their last 12 months, the company has a 6% current free cash flow yield. All 3 of those numbers are better than the benchmark we wanted, which makes this a check on metric number 6 for Chevron. Don't just run out and go buy the business, watch our next 2 valuations before you stay for their fair value at the end of the video. Next, we'll use a DCF model to give Chevron credit for its growth. We'll grow their cash flows into the future using historical assumptions. Let's say Chevron grows by 5% in each of the next 10 years. Then in the following decade, let's say they grow by 4%. We're also going to add in their tangible book value, which gives an estimate of their net worth. If we wanted a market-beating 15% rate of return, which is the same return Warren Buffett looks for, then today, based on a DCF valuation, it looks like a fair value for Chevron is around $170 per share. Keep in mind, even though they've grown their dividends for 37 years in a row, Chevron hasn't been super predictable as a business. The 2010s were hard on oil companies, and oil went negative in 2020. This is why, based on past multiples and future estimates for their growth, our third valuation comes in at $162 per share. Now, Warren Buffett likes Chevron's numbers, but it's the company's qualities that are the main reason he's buying. Why don't we learn what these are for Chevron through a long and a short thesis? Number 1, returns and free cash flow generation should continue to improve thanks to a cap on capital spending and the addition of higher margin production volumes. Number 2, Chevron's large Permian position is mostly comprised of legacy acreage, meaning the firm did not overpay to enter the play. 75% of their acreage has a low royalty rate or none at all. This gives them a significant cost advantage. Number 3, Chevron should realize improved downstream earnings and returns. This comes as conditions in their California refineries improve and new chemical production capacity is added via its CP Chem joint venture. Yet it's not all positives for Chevron. Let's look at a short thesis as well. Number 1, Chevron may be unlikely to ever see earnings or returns on par with historical averages. This comes with higher costs and investments and potentially lower oil pricing. Number 2, Chevron's focus on the Permian for growth could leave it exposed to cost inflation. This is given the high levels of activity in the region relative to other basins. Alternatively, it has a high decline asset that requires high levels of reinvestment. Number 3, relatively little investment in new business models outside hydrocarbons leaves Chevron exposed to potential value destruction. They could also strand resources if oil demand falls faster than expected. Now let's put everything together for Chevron. In our fundamental review, we learned the company goes 5 for 6 on the Select 6 analysis. They've grown, they returned capital to shareholders, they use reasonable amounts of debt, and they're producing a lot of free cash flow compared to their market cap. Still, the company didn't have the current ratio we wanted, and they're earning just slightly better than average returns, down from being a truly wonderful company. Plus, there's a lot of public opinion about the future of hydrocarbons, especially in the United States and Europe. This is why when we look at Chevron's value on our investing tools, today it comes in at around $165 per share. That's $10 above their current stock price, and it's in line with the price Warren Buffett was most recently buying at. Chevron looks like it's fairly valued. To find more undervalued stocks, sign up for our investing tools and get exclusive bonus coverage of 98 stocks and counting.